about a radioactive trade. Do we allow for continuous holding? Sure. I can hold the position all the way to January if I want. Most likely, when I get to, if I'm still in the position, if I get to September or October, yesterday or 2 days ago, I bought the stock and bought the January 2019 put. Now, when I get to September or October, if I haven't met my goals, but I think Sony has upside, or if I've exceeded my goals and think Sony has upside, at that time, on October 2018, I might roll my January 2019 put, which is still 3 months away, out to March of 2019, maybe out to July, maybe even out to next September. I may hold it, but add to the put to have the insurance in place, depending on my outlook for the stock and what I've received. That's all in the blueprint. Now, the concept of building a position. An investor may decide to go out and buy 40 or 50 shares of Sony, let's say. And then if the stock does what they want after the first day, or after a set time period, it moves up 2 or 3%, they might buy another 50 shares. And they see it move up again 20 days later, and then they might buy another 50 shares. So they're building a position, they're adding to it, or maybe they're collecting dividends and adding to the position. And the reason why they're doing that, they started off first with only a small allocation into the position to avoid taking a large risk if it goes against them. But the question is, I don't worry about the building, or what some investors call laddering, and some investors do this with long calls. Well, they'll maybe buy a 50 strike call, and as the stock moves up, they'll buy a 55 strike call for a different expiration. And then if the stock moves up again, they'll buy another one. So they have 3 blocks of calls open and laddering the position. And some do this with covered calls. To me, with the radioactive trade, I don't bother with the building or laddering because I took in a specific position size to begin with, meaning that the funds I allocated and the monetary amount I allocated, if I bought 300 shares in 3 puts or 200 shares in 2 puts, means that I have the proper position size, but the maximum risk only represents at that time 1.5 to 2% of my total portfolio value. So I'm set from the beginning in the proper position size, and I don't worry about building and building and building. Now, 5 months from now, I can't say it's going to happen, but 5 months from now, if I have 6 to 8 radioactive positions open and Sony is still outperforming the other 6 that I have open, then what I may do is continue the spread, as I mentioned, roll the put out to continue it for longer time for further growth as it's outperforming expectations. Or I may open a new RPM entirely, not merely adding to my position that exists, but adding a new one. I very rarely do that because I already have my protection in place, my allocation's already covered. But if I'm exceeding expectations and I still feel the stock could exceed further expectations, maybe I'll add a new radioactive trade later on the line. Now, I didn't understand where Michael got this from, probably from some of my comments during the webinars, but he says he continued with part 2 saying the radioactive trading seems focused on getting an increase in the first 30 days or calling it a small loss. That might be a misunderstanding. I'm not really intending on closing a position, a radioactive trade that I open. For example, Sony is down. We might take a look at that position in a little bit, and I'll extrapolate on this idea. When I open a radioactive trade, I mentioned in the webinars and in our free webinars here that I open a position that I feel has the best potential of the 5 or 6 trades that match my list, that match the criteria I want to use. I'm picking the one out of that 6 or 10 potential trades that I feel has the best likelihood, based on how I analyze stocks and everything else, stock charts and other information, but has the best potential to move up, let's say, 3 to 6%, maybe 3 to 8% in the first 30 days. And has a good potential of looking for maybe 15% or more over a 6 to 8 month period. That's the trade I'm opening. The first 30 days is a checkpoint to decide what I'm going to do next, not necessarily close the trade. Okay? If the stock had moved up 3 to 8%, or let's say 3% as I expected in the first 20 to 30 days, I'll make an adjustment. If in the first 10 days the stock moved up 5%, I would have made adjustment before the 30-day check mark. Okay, this is just a checkpoint, lack of a better term. If the stock hasn't moved in the first 20 to 30 days, now I say, well, has my sentiment changed? And if it has, then I might do one of the neutral adjustments as opposed to waiting for it to do a bullish adjustment, or I might prepare for a bearish trend going forward to the next 20 to 30 days if I think the stock's going to pull back. If the stock has fallen in the first 20 to 30 days, down 2% or 3% or so at the 20, 30-day checkpoint, well, I may adjust it with one of the bearish income methods to lower my costs in the position and sort of average down without putting more money into the trade if I still have a bullish expectation. If I think the stock might continue to fall, I'm going to do something else. Now, if the stock's already fallen 5% in the first 10 days and it just seemed as though I was wrong, I may liquidate the trade at that point. I may do something else to try to profit further to the downside. But it's not that I'm planning on closing it at that 20 to 30. Very rarely will I close a position I just opened at the 20 to 30 day mark, even if it's not doing what I expected. That being said, our Fusion subscribers saw a trade that Greg had opened. Fusion subscribers can track my radioactive trades, Ernie's or Renner's radioactive trades, and Greg's or Renner's radioactive trades. He closed one out the other day, I think, for a double-digit return. He was only in it for maybe 15 to 20 days. The reason why he closed it is because it exceeded his expectations. It might still go further up, and he realized that. But he wanted to take those profits off the table now and then reinvest them somewhere else. Okay, so that was part of his plan. But very rarely am I closing the position. Most of my positions, when I open a radioactive trade, the put is around 8 to 10 months out in time, 240 to maybe 300 days out in time. And my average hold time in a radioactive trade is about 200 days. Now, another factor that dissuades me, for lack of a better term, from increasing a position after I've neared my put expiration, if I've been in it for 5 months, 5.5, 6 months, one of the main reasons I don't want to extend it further out and continue the trade for another 6 to 8 months is because, well, these are my real trades, but I'm posting them for the Fusion subscribers. So someone who subscribes to Fusion is in for 20 to 30 days and sees this trade that I've been in for 180 days and says, okay, well, Mike's got 4 positions open. This one's been the longest. He's probably going to close it soon, or he's got a decent profit. He's probably closing it. Well, if I roll that position out for another 200 days because I already had gains in the position and I could roll out without taking on risk, it could still be bulletproof, well, the new investor doesn't get any advantage of that. They could jump into the position at that time, buy the stock new, but I'm treating the position with, let's say, a locked-in 6% gain. They're still having a 6% potential loss over that 6 to 8 month period. So the income methods I use might not really apply to their position. So because I'm actually posting my trades, I try not to extend them for longer than 200 days so that new Fusion subscribers coming in always have an active new trade that they can follow or they can take a look at as well. Okay. Now, one brief moment here. Okay, I apologize for that. One brief moment here. Let's go on to our second question. That's for Mike C. Sam sent in a question via email. He wants to discuss a potential earnings trade in Apple. It was actually the 170. It didn't copy over right. He wants to buy a 170 straddle, call and put, for 4 weeks out, and this looks like 28 days is February 23rd. And at the same time, he's going to sell the same strike straddle for a credit, okay, near term, and this is going to be a double horizontal spread, and he's hoping for a volatility crush as well. All right, so, I mean, that's a good play, but let's take a look at it on PowerOptions here. Sam also says hi to everyone in the room and good afternoon. It's a great week for the Dow, 2550 there. All right, so, but let's go over to PowerOptions, and we're going to build this Apple double horizontal spread for earnings. Now, I'm not saying it's what I'm going to do, but we're going to take a look, and I'm going to break it down based on some just brief analysis. Let me make sure here. All right, so I went to powerop.com. We logged on to our webinar account. I went into the custom spread tool here, so we're going to build this on the fly. So let's put in our symbol, AAPL. And the first thing it's going to do is we're talking about buying a straddle. Same strike call, call and put at the same time, same strike, gives us that nice little V profit and loss chart for earnings. Said 4 weeks out, 28 days. I looked at the prices. It was about the 170 would be close to the 1013 he had mentioned. Okay, so let's just go ahead and buy 1 and 1. Let's keep the math simple, use 1 contract apiece. All right, so this comes out to be about 1078 right now with current midpoints, but we're going to lower that a little. Let's take 35 cents off here to lower this down to 565 time. And then we're going to go ahead and let's see here. Let me go down. I just wanted to clear something up. There we go. Okay. All right. So we dropped that 35 and I'm going to drop this about 30 cents or so to 448. Oh, sorry, 448. Okay, so this would be our long straddle priced at 1013, 565 for the long, February 170, 448 for the put, stocks at about 171.51. By itself, an expiration 4 weeks away, if the stock was trading right at 170, we have the full loss of 1013. Break even of 180 and 159 to the downside. Static expiration, not next week, not at the halfway point, but the static break even if we held it all the way to February 23rd. Now, Sam wants to create a double horizontal. All right, some of you may be familiar with a double diagonal. We're using different strikes, calls, and puts, and you've got a range between it. Sort of looks like a curved iron condor position. But this is a double horizontal. He's keeping with the 170s. Next week out to get a credit of about 770. So he's going to sell, again, same strikes, 170 and 170. So there's not a lot of monetary obligation here because the short call at 170 is sort of covered by the long call at 170. And the short put at 170 we're going to sell now is covered by the put that we own at the 170 strike. So there shouldn't really be any monetary value here. Nothing is naked. Okay, we've got a debit of 233. You mentioned 236. Let me add 3 cents to the put here. Oh, nope, 312. So we're close. We're in line with what you were seeing earlier today. All right. So again, 1013 for the cost of the far out straddle. Near term one generates enough premium to we lower that down to 736. We generate about $6 and $7 or so of credit on the position. Now the max profit if the stock's trading right at 170, of course, is 688, almost 300 times the debit of 236. Low cost, low risk. Now the earnings, everyone hold on here for 1 second. To look at the earnings real quick on Power Options, I use the More Information button and I go to Stock Research, whether you're on the search or the search by symbol. And the earnings are coming out on 2/1 after market. Okay, so before our short-term expiration on Thursday, yes, Sam, thank you. But before Friday's expiration on the 2nd of February, earnings are going to come out. Of course, we could see the stock gap up to, 170, 180, 185 where we're nearing that risk. Or it could drop down to 165, 164, somewhere in that line. So his break even is a 21-point range. And this is at near-term expiration, 160.30 and 181.04, upper and lower break even. Okay. Now, what Sam is saying is that he's hoping for some type of, well, in addition to having a decent range to break even on this position, 21 points. Okay. You're expecting a similar, like a Netflix move. Okay. That's fine. But Sam also said he's planning on seeing an implied volatility correction. Okay. The problem is that I think, Sam, in this type of play that's this close, only 4 weeks out in time, you're hoping for an implied volatility crush on the short options so it's cheaper to buy back. Yeah, these February 2nds are going to go to zero. One's going to go to zero. One's going to go to intrinsic, depending on where the stock is trading. You're going to have a volatility crush there. But you may also have a volatility crush here. And that's something that's hard to gauge. we don't know what the outcome is going to be. And you're expecting maybe a 20% increase on Apple, like you saw on Netflix. That would take us up to about the $200 range, and you're at a loss. The implied volatility crush will hurt you in both directions. Okay? These are about even. What we're using here in the volatility analysis down below to calculate what these options would be worth at a given date between now and expiration is what's known as the SIV. This is the stock's implied volatility value. It's the average of the in-the-money and out-of-the-money calls and puts over sort of the next 2 months of expiration cycles. So that's why they're all the same. But let's look at this individually. This is something that comes into play where you talk about people needing, some webinars talk about investors needing to know the IV percentile or IV rank. Well, this kind of trade, or even just a long straddle by itself, I focus on the percent implied volatility range. And that's showing me where the option is now compared to where the total implied volatility has been over the life of the option since it was released on the market. And how can I check that? I've built my spread here in the custom spread, but I'll use the more information button again. This time I'm going to go to research. I'm going to go to option research. This is for a 170 call that we've sold in our double horizontal. My current implied volatility range is pretty good. It's 4%. I got to throw that out. I don't know when that jumped to that level, but you see here we have all of the implied volatility history for this option since it was released on the market. I think we had some bad data jump in there. It should never have been that high, but yeah, right now it's at, honestly, it's at 90%, not 4%. I've got to look into that. That's a strange intraday volatility spike that doesn't make any sense for this particular option. But right now you can see the current implied volatility is at 0.4049. Since this option was released, that's the high. It's been at 0.34, 0.31, 0.27, and so forth. It was released on 12/21. Okay, so it's at the 90th percentile. What does that mean? Well, that means I agree with Sam. When this collapses, when we have earnings, our short 170 for February 2nd is probably going to go back to this level. If the stock falls, our 170 call is probably going to go to zero. Not implied volatility, just straight value. Okay, but this is going to see a volatility crush. But it's not going to matter because you're so close to expiration that, again, whichever option the stock goes up, the call will be in the money and just be intrinsic. If the stock falls, the put will be in the money and will be intrinsic when the call goes to zero. Let's look at the others. Now, as I mentioned, since it's under 30 days out in time, any option that is under 30 days to expiration, we use that SIV number. That's why they're all the same. But those far out options are also inflated because they're also going to be affected by the earnings on February 1st. So let's take a look at the 170 call. We're mad at the programmers if this is erroneous too. Yep, it is. Never went that high, so let's look at the graph. The closing prices, of course. These options have only been out since 1/4. That's 0.22 was the start. We go along the line, 0.22, 0.23. Okay, so this hasn't moved much. It's at 0.27 now, 0.2703. So if anything, this would just revert back to maybe 0.24, 0.22, its lowest value. That's not going to affect it too much. Now, how do I know that? Well, let's take a look. Let's put our theoretical implied volatility, at 0.2245. Or 2145. I'm sorry, Sam, 2145. Okay. Now, what's interesting about that is that these two options, are going to go to, this is saying if the stock stays at 171.51. Let's go to expiration. Okay. If the implied volatility for those further out options stays at 0.2145, well, you're going to have a loss of 128 on the short, 276 on the long, and as I mentioned, this would go to intrinsic. That's assuming the stock stays at 171.51. Well, what if it gaps up 30 points, close to 30 points? Let's say it goes to 200 on February 2nd, Sam. This is a loss of 226. Why? Okay, well, your 170 call goes to intrinsic value of 30. You've got to buy to close it. The 170, which is still 3 weeks left to go to the 23rd, is also just going to go to intrinsic. All right, so that's kind of a wash there. You're not getting anything positive profit back. And you lose everything you paid for on the long, and the short just goes to zero, so you keep the 312. So based on these numbers, with implied volatility dropping back down to its low after the earnings 2145 or maybe even 0.22, you'd be at a loss here of 226. And then you had mentioned that, well, you'll add calls and puts in the morning with the trend of the stock. Okay. And you did the same spread on Intel, and it did good on the gap up. Okay. And I understand what you're trying to do here, but for me, this is inverse of what I like to do. I like the fact that you cut down the entire cost of having a long-term straddle by having a shorter-term straddle in place. We can call it that. It ends up building this double horizontal, as we discussed. But if you're expecting a 20% gap, why set myself into a target where I'd be at a loss on this, especially because the volatility is going to affect all 4 options, not just my 2 shorts. It's going to have a big effect on these 2 as well, because market's going to go back to normal. But why structure a trade that's going to be at a loss if it does what you want with the plan of closing X, rolling Y, adjusting Z, and then adding more A and B? I know that's how you trade, but to me, I'm saying, well, couldn't I do better if this is my expectation here or here? Is there another structure? I would do the long straddles, and I know you don't like that because by themselves you suffer the volatility crush. Thankfully, those longs doesn't look like it's too bad of a volatility crush, but it's still going to affect the position. So this is a low risk, low debit position where you're going to have forced to make adjustments to profit. I'm not saying it seems opposite to me, but if I'm playing an earnings play, I'm playing the gap one direction or the other, or no gap if that's my expectation, like we saw today with a couple other stocks. I'm sorry, I had a question from Michael B. come in regarding LRCX, I think it was. We might take a look at that if we have time. I gave Michael a response, told him I might not handle it in the webinar, but we might look at it as well. Okay, so that's the idea here, and I get this question a lot. Someone will say, Mike, well, if you're doing a straddle for earnings plays and it's the one, buying a straddle, which we saw first, you're going to suffer a volatility crush on this position. Well, I don't think it's going to be that bad, actually. It's going to affect it, sure. I mean, if the volatility stayed at 0.40 to February 2nd here for earnings, and the stock didn't move, I might expect a $300 profit. How can I expect that if it doesn't move? Because, well, it's still retaining a lot of value. It jumps up to 178, for example, and the volatility holds at 40, I'm at a profit of 470, a 40% return, an investment of 1013. Okay, but what do I know is likely to happen? It's likely to revert back to the norm after Thursday, and this might actually be a loss. Even with the stock going to 178, my straddle might be a loss because of volatility collapse. I have to anticipate that it could go to the worst possible value of its entire implied volatility range. And how do we check that again? You go to the more information button for the option. Let's look at the put again. I'll go to research and then option research. Let's see, this one's more realistic. It didn't get that extra number there, but 0.2327 to 3056, and we're at 0.29, so we're at the 80th percentile. So if I expected after earnings that my 3-week out, 28-day out, February 23rd put reverted back to its lowest volatility, the lowest implied volatility since it's been open on the market of 0.2327, regardless of the gap, that's the number I would use. So in the worst case scenario, and that makes sense, doesn't it? The 170 would be essentially a little bit above intrinsic, and the 170 put might hold something, even with a volatility of 0.2327, but it's still only a small profit. So selling in, and as Sam adds, he says, I want to take it because I covered the money that I had. He had a lucky day with Twitter, a big gap in Twitter, so he's playing with house money right now, and that's fine, Sam. I'm just saying for everyone else here, is that kind of, is it better to have a V profit and loss chart going into earnings where you can profit in both directions with a large gap, or is it better to have a profit and loss chart going into earnings where you're cutting into the loss, so the max loss can only be 200 or 236, but then you have to have a plan in place already to make adjustments, because if it gaps as you expect, you're in the loss area. So what's the better plan? What's the better play? It's hard to say. It is really, really hard to say in that scenario because it's depends on what the stock does. And in your position, if the stock does nothing, if earnings fall flat and it just moves up 1 or 2 points, this is going to be a beautiful trade. If it moves up 10 points, you're still looking okay. You're right at that upper break even, remember we looked at, and so am I, but I'm not quite making a dime yet. You're still in the profitable zone. I haven't made really a dime yet. I'm very close to it if it goes up, let's say 180. If it spikes up to 200, I'm looking really good. You need to make adjustments based on what you're looking at next, okay? And you had mentioned that you did a laddering with the Amazon debit spread. That was from our previous discussion. There's a $30 wide spread, and when it went from 1320 to 1400, you laddered that position. And don't get me wrong, laddering with options can work out well. I just don't do it with the radioactive trade because I have it set up structured from the beginning with the amount of money that I wanted to allocate to the position. And so I'm not worrying about adding to it later on or making another adjustment there. All right. Okay, so that's for Sam's Apple position, the double horizontal going into earnings. We saw the sort of tent profit and loss chart versus the V profit and loss chart, the pros and cons, and how you can use Power Options, how you should use that tool, the custom spread tool, to anticipate going to the lowest level of implied volatility after earnings for all of your available options to get an accurate depiction of, is your spread going to be a gain or potentially be a loss based on volatility crush? Okay. Half of it would work in Sam's favor, the other half would hurt it. The structure I showed you with just the simple long straddle for earnings, it would hurt mine more. And I plan for that. All right. John, you've got one question, then you had 2 follow-up questions, so I'm going to get your first question, then I'll do your 2 other questions right after that, and then we'll get to Arvine's question. I don't think your first one's even a question, it's just an observation. John says, Michael, I just started reading your book on naked puts, which you wrote with Ernie. You're also going to receive your other book, Protective Options Strategies. Okay, good. Should be great reading. Now, I'll say this, they're old, and there's nothing wrong with being old, as Ernie always tells me, because he makes more money than I do each year, so he says there's nothing wrong with being old, it just has experience. The Naked Put book, I believe, was published in 2009. We don't have copies anymore here at the office. I'm sorry, it's 2008 was the Naked Put book. We don't have any more copies at the office. It's called Naked Puts Power Strategies for Consistent Profits, but you can pick it up at Trader's Library. Trader's Library has a lot of books. You can just look for my name or look for Ernie's name. You'll see the 2 books that we wrote. Ernie wrote another one on iron condors with a gentleman by the name of Mike Phillips. The Protective Options Strategies book. This is my favorite one. The Naked Put book was good. I'll get to that in a minute. This is also around the same time. I think we published them both in 2008, about 10 months apart. The Protective Options Strategy book took my position on collars. And I introduced some of the radioactive trading concepts. Was really my take on collars, calendar collars, debit collars, the different structures investors can use by entering the short call and the long put at the same time. And then we do spend some chapters talking about radioactive trading and buying the put and then waiting to sell the call. If you go to, I don't have it here, let me go to other strategies. If you go to long collar, of course, my apologies here. If I go into the search for long collar, what I mentioned with about the debit collars and calendar collars and things of that nature, oh, if the programmers just reset the site on me to do a data run, I'm going to be very upset. But hey, they have to do that to do a data run, so that's, there we go, fantastic. So anyway, I had a customer ask me this a couple months ago. Says, why do you have so many default settings for the collars? Standard collars, that's the screening criteria I use. If I'm going to buy stock, sell an at or out of the money call and buy an out of the money put today, that's what I use. Well, you could do debit collars, where I buy a stock, maybe at 50, buy the 50 strike put and sell a 52.5 call, gives me very limited risk, higher potential upside if the stock moves up. It's a different structure. Still a collar, but it's a different structure and a different approach. Lower risk, higher potential return, lower probability. You want to buy puts that are further out in time and in the money and sell the call right away? Well, that's different months put in the money. The different months standard form. I want to buy a put that's 6 months out but below the stock price. I want to sell a call near term that's above the stock price. Different months, standard collar form. The reversed long collar for different months, reversed long collar for same months. What does that even mean? Well, the reversed long collar is where I might buy a stock at 50, sell an at the money 50 call 1 week out or 1 month out, and buy a 55 put. The same expiration. Oh, these are supposed to be same months. I'm sorry. Let's change that. There we go. Now, why would I do this? It's an interesting, Valiant Pharmaceuticals. Okay, let's do JetBlue Airways, and let's just look at the chart. So what I'm going to do here, I'm going to buy the stock at 2050, sell the March 49 days out 21 call, and buy the March 23 put for 270. Well, that's another debit collar. Why on earth would I do that debit collar when I have the same expiration, when I'm not treating it as a calendar? The reason why, some investors call up and they say, I'm on level 1 trading. I want to take advantage of a bearish market, but all I'm allowed to do is covered calls and buy puts against the stock. They can't buy puts on their own. They can't buy calls on their own. But they want to be able to profit in a bearish market, and doing a covered call won't profit in a bearish market. This structure that we call the the different months, or the same month, excuse me, reverse collar, this is the same as a bear call credit spread. But you can do it with only level 1 trading in a restricted IRA because you purchased stock, you sold a call close to it, but bought an in-the-money put to increase the debit, but you can still get a profit, 2.7%, if the stock stays below. Well, what happens in that situation? If the stock stays below or falls, your call expires worthless, you sell to close your position at 23, you only had a cost basis of 22.40. You exercise the put, get out at 23, 2.7% profit. You're mimicking a bear call credit spread even though you can't trade a bear call credit spread. It's a way that investors in restricted accounts can take advantage of bearish markets if all they're allowed to do is covered calls. Or you can stay in cash. But this is a solution for that small environment that's restricted accounts, okay? So that's one idea there, John. But what I'm saying is for the Protective Options Strategies book, another reason why there's so many here is because there's different ways to approach a collar. That's all that's discussed in the book. All of these are broken down in the book to the advantages, disadvantages in the Protective Options Strategies book. And of course, conversions, where you do the same strike to have a potential guaranteed profit, whether the stock moves up or down. No risk trade, essentially, a conversion. The opposite's a reversal when you do a short collar. Sell the stock, sell a put, and buy a call. You just don't do it on a dividend-paying stock as well. Okay, so that was just the observation, but I just wanted to go over the books there that we were talking about as well. Now, back to the married put conversation. John's second question is, when deciding to exercise your put option, just need to give notice to your broker? You've never had to do this. Yes, I have to do that. 9 times out of 10, I'm liquidating the position. Okay, what do I mean by that? That's a great question. Okay, hold on one second. I don't have the numbers here on my webinar account. We're going to put in my newest trade here. Doesn't look good. That's okay. No one's perfect, myself included. But let's go ahead and go to RadioActive Trading so I can see my newest trade. It looked really good at the time, and I'll show you exactly why I selected it and what I was hoping for. But I don't have the numbers. I know it's 50-50 for the stock and 750 for the 55 put. I'm almost positive that's what it was. So here's my open trades here. Let me go to Sony. Yeah, I only have 2 now. I closed out 4 positions in the last 3 weeks in Fusion. I'm going to open a position a week for the next 3 weeks. Some might be bearish setups, but I'm doing that for our customers that just bought the blueprint. But there it is, yeah. Bought stock at 50-50, 2019 55 put for 750. Even number, I like when that comes out. 58 invested, 55 guaranteed back because of the put. Maximum risk, $3 or 5.2%. Why is that important? Let's plug it in. Okay. This is for John's second question regarding when to exercise the put. So I bought technically 200, but we'll do it at 100 at 50.50. Jan 19, 55 puts. A customer of mine got in at the 52.5. They wanted that lower cost to be closer to the put strike price and I'm sorry, closer to the current stock price, and they were okay taking the 8.8% risk it came with instead of the 5% risk I had. All right, so there's my structure. Now you see the stock's at 49.48. Oops, sorry, I've lost $1 on this position. It was worse. It was about $2 losses of yesterday. Let's take a look at the chart. And I can't mimic it lower than I want. So, oh, I can. I'm just going to use a 5-day chart here. Hourly, why not? Okay, why 5 days? It's because I opened it here. It had this, we had this fall from earnings and it came down and then the MACD cross and it had almost a Bollinger Band breakout. So it would have been, oh no, I'm sorry. Sorry. I keep thinking I'm looking at a 2-month chart. My apologies. Yeah, I got in, not necessarily at the high, but I got in right around here. Okay. 3 days ago, Monday, 50.50. Was loving the look early on Tuesday. Then after hours, slump. Okay, so this was looking pretty good. I was almost tempted actually to do a bear call spread at the 52.50, 55, but I thought, well, if it continues up like this, I'll do better at 55, 57.5, but no, wasn't to be. You see it dropped well below 48, almost to $48 before it recovered back up. I could have done all these little things in here, but that's not, it's a long-term hold. Okay, so let's just say that all of a sudden now, John, I've decided that, you know what? I don't like this position. It didn't start out as I wanted to. Oh, why did it drop, by the way? This is important to note. If I check the news, I could show you, but I'm not going to do that. I could just go to the news. Well, the day after I got in the position, and I should have told everyone this, if I buy it, go ahead and short it. You'll do better. Just kidding. JP Morgan came out and said that, you know what, we don't think the market is going to need these expensive 3-sensor dual vision cameras that Sony's making, because it seems in China now that everyone's buying the smartphones with the cheaper cameras. No one's really concerned about all the over adaptations for lighting and selfies and portrait mode and everything like that. So, and it does look like too, JP Morgan said that Apple X and Apple 8 sales aren't going to be as good or as strong as they expected. No offense, Sam, I know you're playing the earnings for a 20% move. I think they're talking about future guidance, that it's going to slow down rapidly with sales on the Apple X, the iX, iPhone X, I guess they call it, and the 8, and so forth. And the 8B, was it? 8 Prime? I can't remember. In any case, guy from JP Morgan comes out and says that Sony's 20% of a lot of its revenue is from these really intelligent, really smart cameras it's putting into different phones, not just the iPhone, but other phones too. And they're saying that we're seeing a trend where it looks like the inexpensive cameras in phones are doing just as good. Not everyone wants to pay $1,000, $1,100, $900 for a phone. Looks like people are doing okay buying the cheaper versions. So what's going to happen to Sony? It's going to go down, right? It's bad news. They're saying that a 20% chunk of their revenue is in jeopardy of being lowered and guidance being lowered, so Sony takes a preemptive hit. I still think it's a strong stock. But John, if I decided right now that this was not worth it, I don't like it, doesn't look like it's going to do what I want it to, and I decide to exit the position. Well, I just bought it 3 days ago. If I chose to exercise the put, which I would not do, but if I chose to exercise the put, I would have to call my broker. Fidelity, I have not found a way to do it there. I know one or two brokers might have it. Fidelity does not have it at their site where you can just say exercise put linked to this stock. I haven't seen it there. Doesn't mean it's not there. I've looked, but it's not there. I'm confident it's not there. So I would call Fidelity and tell them to exercise this put. But that is a terrible move at this point. Why? Because I bought a January 19 put that was $4.50 in the money, and I paid $7.50 for it. The $3 is the time value. That's my risk. I've only been 3 days into the position. So I don't want to exercise it and get only 55 back. take the $3 loss, the maximum loss on the position, I want to, and I know this isn't your question, I'm just using it as an example, John. I want to sell to close my put, which has a value of 830 at midpoint. I'm going to sell this out at 830. And I'm going to sell the stock. Oop. You know, the 100 shares at 49.50. I'm going to take a dollar loss there, right? But I'm making 80 cents on the put. So what does that mean? Well, it means grand total, even though I'm in this position, the stock's dropped $1, I'm getting 80 cents on the put, I'm losing $1 on the stock, so I've really only lost 20 to 30 cents in the entire position from my cost basis, right? You know, 80 cents profit, $1 down. Yeah, so, you know, I'm only losing about 20 cents. I'd liquidate. That being said, let me look at my other trade that's out to April. The other trade I have open that I haven't closed yet that I'm still actively trading. AMAT, my cost basis after adjustments is I own shares of stock at 57.47 because I used income method number 4, and I own the 60 put at 5.50, and that's for April. Okay, so this is more of a better example of when I might choose to actually exercise the put. Whoops, sorry folks. Exercise the put as opposed to closing it, but I think I'd still close this one too. I'm waiting for earnings on this one to make my next move. I'm going to make a move before earnings on AMAT. 57.47. I bought the April 60 put for 5.50. Now that 57.47 includes the adjustments I made. The original cost of the first put I bought plus the debit to roll. And this is about break even. I'm sorry, the put is about break even. The position as a whole is at a loss right now, okay? So this is an April put. I'm at a small loss right now of about, I think it's 190. I think, no, yeah, it's about 180, 185 when I looked at it earlier. Max loss is 4.7%. Now, as you saw, the stock's at 57.12, so that means my 60 put is 288 in the money. So this one, you know, I wouldn't exercise. I'd still sell to close it because if I sold it for 5.50, I'm getting an additional 170 back in time premium. However, if this was the 65 put and was trading right at 820, it was trading at intrinsic value, meaning it was deep in the money. The stock had gone up to 64. I rolled to the 65 put, now it fell to 57. So if it's in the 65 put at value 820, now the stock at 57.12, this is priced at 820, just a little bit above intrinsic, I might try to exercise at this point. Rather than try to get a midpoint and then sell to close the put and then sell to close the stock, then I might go ahead and just exercise this. If it's close to intrinsic value, you're close to the maximum risk, you want to be out of the position, then it's fine. But 9 times out of 10, I'm just selling to close the put, John, and liquidating the entire position. Okay? So that's what I look for with closing the put. If my sentiment has changed completely, for example, if I think that the stock is just going to drop, I was wrong in the first 20 to 30 days, and then the next 30 days, 60 days in, the stock is just dropping, I may liquidate or may just close. If there's a wide bid-ask spread and I have a feeling that the market maker is trying to get me to pay get much less for selling to close the put, then I might just exercise and be done with it. Just get out if I was willing to take the risk to begin with. Speaking of which, let me refresh my memory. I looked it up yesterday, totally forgot. Yeah, so my earnings are coming up on around 215 for AMAT. So that's why I'm still holding this position without doing an adjustment yet. It did have a nice run recently from about 51 in December to 58, and then it pulled back down a little bit to 57. So it likes to bounce around. Sam, that might be a stock. Nah, it's not Sam's type of stock. I was just saying, Sam, you might want to check out AMAT. I know you have in the past, just because it looks like almost every 3 to 4 days there's a swing from 58 to 56 or maybe 55, then back up to 58, then down to 54 3 days later, then maybe down to 51 or maybe back up. It's tough to gauge, but it's just moves. It's been moving almost $1 a day one direction or the other. I don't like to day trade that way. I don't like to try to pick the trades, but I've been in it for 3.5 months, so I've just been watching it since it hit its peak at around 60. It's just dropped. And then when it came off that $51 low, it's 80 cents to $1 movement every day, it seems like. All right. To Arvind. He says, I just want to know about OHRP stock. I bought the stock, it went down. I try to sell. Sometimes the premium shows 6. Some sells or buys different premium. How? Okay. Okay, so it's a 33-cent position. Had a huge gap down recently. Probably failed a phase 2 or phase 3 drug trial there. So now it's just bouncing around these prices. I guess your 6 is what you're saying is that your number of shares, maybe 200 shares at 30 cents or so is your 6. Please explain. Well, there's not much for me to explain. This is the gamble with these lower price stocks. The percentage-wise, they're going to move by a factor of 5 more than you see on a normal stock. Not moneyness, but percentage-wise. The bid-asks are all over the place, just like an expensive option, for example. I don't want to look at SMA. I want to look at 5 days, 10 days. Let's look at a 10-day, 5-minute. I can go 1 minute. It's going to be hard to read, but let's go 1 minute. Let's go 5 minute. It's impossible. Maybe even 15, but let's try 5 for 10 days. Maybe I should go 5 days. Yeah, it's not much better. I mean, it doesn't seem like it's a lot. Let's shorten it to 5 days. It doesn't seem like it's a lot of movement, I know, but a move from here, I'm in the 5-minute chart now, by the way, but this movement from here, 5, 10, 15, 20 minutes, but every 5 minutes, you see from between 34 to 33. I mean, a 3-4% move every 5 minutes, right? Percentage-wise, that's why it's tough. And it's really tough. And I mean, you think about it in a hour period, you went from 36 down to 33, almost 32 at one point. So, I mean, that's over a 12% move in a 1 hour down to 33. Okay, so we'll call it a 10% move in 1 hour. And then at the open, it was another 10% move and then stabilized off. It's just going to move too quickly, okay? And you say when you try to sell, you don't get $6 per the stock. When you try to sell, you don't get $6 per the stock. Yeah, on the 33 cent, based on the numbers there, I don't know. This is a question for your broker, why it's not getting triggered. I don't touch anything like this. The lowest price stock I ever trade was Omex. It was Odyssey Marine. Now, that stock was so much fun for a little. It was the first stock I ever bought, by the way. He had a short put and he tries to close the position. Okay. Has a short put on OHRP from a while ago. Okay. I think that's what oh yeah, there's nothing there. There's no, yeah, you're going to need to talk to your broker. They sort of switched there and did a major change. So the put, any puts you had when it was trading up are probably disappeared now. But anyway, Omex, I don't even know if it's still listed, to tell you the truth. I think it is. Actually, I think it was on my front page there. Oh, it's at $397 now. Odyssey Marine Exploration. It was the first stock I ever bought. And memory serves. Oh, you were up at 5 recently. How funny. I think I bought it at $250 and traded. I bought it at $220. Now, this is back in 2001, mind you, 2002 when I started working with Ernie. But this was the first real stock I ever bought for options trading. And I just did it as a covered call. Bought the stock at $220, sold a $250 call. And this was when it only had $250 and 5 strikes and only monthly expirations, of course. I must have sold that $250 call for 10 months at 22 to 23 cents a pop, and it stayed right at $250 to $220 for a year. I paid for the stock and had no no money in it whatsoever. And so I just played with that. I added a little bit here, added a little bit there. 1 decade will go back. This is not a strong stock to get into at all. It's hysterical to me because this stock is some of you may remember it, this is a treasure hunting company, essentially, is what they are. Salvage company and a treasure hunting company. And these are the guys that this point here, this time frame in here, you know, I'd been in it since 2001, 2002, but in this time frame in here, remember that company that found the San Francisco Domingo, I think it was, near Gibraltar, and they were the salvage ship hired by Spain to find it, salvage company hired by Spain to find it, and then in the middle of the night, they flew 2 planes out of Gibraltar loaded with silver and gold coins and essentially tidy cat plastic tubs to Florida because they knew what they had found and they knew what it was and they didn't report it and they flew it back. And they showed pictures of them unloading it and they thought maritime law was on their side. So the stock did this because they were sitting on millions of dollars in gold and silver all of a sudden for a very small company. And then after a year of deliberation, the Spanish government said, nope, that's ours. So it went to here. Then they found another treasure. And then they just have been poorly managed. They're always looking for the new treasure, and they just sort of stay in this range. Anyway, I'm sorry, this is wasting time. It's just a fun little story. It was a lottery ticket stock is what I called it. I paid $2.20 for it, sold against it, and paid for it, and got good money on the rise up here. Always held 20 or 50 shares of stock. I mean, I had 500 shares at one point, sold them out early at 20 and 30 as it was moving up. That's what helped build my account to start doing other strategies, this one trade. And dry ships. Dry ships in the heyday of the Greek shippers. I bought that one, I think, at 40. No, it was lower than that, maybe 30. But anyway, rode it up to 80, sold out, watched it go up to 120, and Ernie said, you should buy back in. This stock still looks strong. I said, oh, no. It's up over 100% from 50% from where I sold it, which is over 100% from where I originally got in. Can't imagine this going above 120. And then, of course, it fell back to 90, then 60, then 70, then 10, then 5, and it's trading at $3 now too. So my earliest stocks here, both profitable, both at the same trading price right now, essentially, but got out of them. Okay. So now Sam did comment with these cheap stocks. He says normally spikes and stay lower for a long time. It's the same with UVXY. It has the same nature. So that's Arvind. He's kind of commenting on that OHPR position there as well. Okay. Sam is asking something we don't normally do here. Sam had also mentioned a stock Mojo. In the cheap ones, he saw Mojo was at 60 cents, then 90 cents, and then dropped off. Sam wants to know if anyone's trading Starbucks right now. He wanted to play the downturn but didn't get in due to the volatility prices there also on that one. Oh, yeah. Sorry, Sam. All the Greek shippers were the same. You had Eagle Shipping, Diana Shipping, you mentioned, was at $2.50, then went up to $28, and then was at $3. Yep. Dry Ships was the big one in there. Yeah, it's not there. See, but yeah, so on this one here, I cleaned it out already. Good. Okay. All right. Okay, this is an interesting question, and I don't know if anyone has an experience with this, but I'm going to talk to Arvind about what I've experienced and what I've talked to brokerage houses about in relation to this. Now, Arvind says, what happens if the stock gets to zero prior to expiry and I've sold a put for $2 and 10 contracts? In theory, if it goes bankrupt, you are going to be kind of cut out for the loss, is my understanding. Why do I say that? You're saying you sold 10 contracts of a 2-strike put on a stock and then it went to zero. OHRP, for example, 3 contracts, 10 contracts, and now it's down at 30 cents or so. Okay. Now, these contracts might have even adjusted to where they're still representing a grouping of share. Even if it goes into bankruptcy, there's still things that have to be settled. And why do I say that you'd still be on the hook for this to buy the stock at 2 and then to try to get out of it and try to close out? Because we've asked this there's different situations that are involved, but we've specifically, Ernie and I have asked brokers about this. And then if I had bought your stock, OHRP, at 220 and bought 10 of the 2-strike puts for the same expiration that you had, and OHRP tanked because they said they were going bankrupt, there is still a period there where it's over the counter and I can exercise my puts and force you to buy them. that contract still has to be filled that I bought. It doesn't just disappear. The two-strike put doesn't disappear. Now, there are cases where that might happen. It's very slim, but there are cases we've been told where that happens. A different type of bankruptcy, a different type of structure. But the contract has to be honored because the trades still have to be altered. It's altered is the wrong term. I'm sorry. The trades still have to be sort of placed and honored in most cases. If you were put the stock at 2, unfortunately, well, even if you weren't put the stock at 2, you should be able to sell to close those puts. I know you're having problems with that, or of course closing the stock itself at this price, because the problem there, I guess, is that, like Sam said, no one's buying it. There's the sharp movements. The other problem is no one's buying it, unless they're trying to hedge a short. Okay, you got put in a long, someone got put into a short at the same time, and they're trying to probably get out of it for profit. So there's got to be some balance in there that's going on. But yeah, for that direct question, I talked to your broker about that in regards to what your expectations are there, why you're having issues getting filled where you think you should be getting filled on OHRP. I'm not saying where you think you should be filled. I'm saying that, looking at the chart again, here, I mean, it still has, where are we at volume-wise? I mean, there's still volume. There's still structure there. So it should be getting filled. I'm not sure why it's not. You might want to check with your broker there as to that. I mean, there's not a lot, 10 million a few days ago and almost 20 million a few days before that. So there's activity there. I'm not sure why it's not getting filled. All right, Fernando, if I have an RPM, a married put that goes well, how can I add more stocks and relative put protection on portfolio to increase the original married put? All right. What have we been talking about today? In my mind, let's see, what have we reviewed? We talked about Twitter. We talked about AMAT. AMAT, that's a decent one. It looks like ATVI. I might use ATVI, Fernando, for example. I'm just going to check the chart real quick. Beautiful. We're going to get in at December 1st at $60, okay? Not a real trade, I know. We're cherry picking. But we're going to go back to December 1st, 2nd, or 3rd there. We're going to take a look at ATVI, Activision. Let me close out some of my windows here. And perfect. Let's go to the chain first for December 3rd. So I'll access the chain, and I'm going to use it here. If you're on a trial, of course, you can go back to 3 months of historical data. Remember, those of you subscribe to the historical data, the upgrade from the 20-minute delayed service, you have 10 years. It goes back to 12 years almost. It goes back to April of 2006 for historical data. All right, so I'm sorry, on December 4th, 2017, May. Probably would have opened a married put with the May series, 165 days out. I could have gone further to January, but we're just going to keep May for the time being. Let's just look at the puts to keep it clean. All right, so Fernando. Wow. That's too cherry picking. That's all the way at the bottom. Let's go to the next day when it bounced back up. Or was it the day before? Let's go back to the day before. It's okay. We'll still stick with May. Perfect. 61.96. I don't want to cherry pick and pick the very bottom of this trade. 61.96. I likely would have gone to 65. I think the 62.5 would have been too close at 3.95. We'll take a look at it, but I think it's too close. I'm going with a 65 at, we'll call it 540. Okay. Let's build the two positions. And this goes back to the other question that we had and said, what, from Mike C. earlier on, not me, Mike C., the other Mike C., about when would you build a position. I'm going to show you how I would build a position and when I would add to it and how I would do it, and for Fernando, how I would treat it in the portfolio. And it has to be specific, 65 put. Now, we would have rolled this much sooner than this, but that's okay. It's 540. If this is below 4%, we're going with a 62.5. We're going with a 62.5. My apologies. Okay, so at that time, we said the May. 62.5 put, 395. There is such a thing as too little risk. Anything below 4%, I usually figure I can do better. Yeah, I mean, I would have taken a 5.2% risk going a point and a half in the half a point in the money. Beautiful trade. Would have been a beautiful trade. We know that. We could see it. Now, stocks at 72.52. I fell asleep at the wheel, was worried more about year-end stuff, year-end promotions, all the things, other webinars and everything. I said, wait a minute. I've got ATVI sitting here and it's up 10 points. I got to do something. You all know that I watch my positions closer than that, but in this case, here we are. Now, I think the stock is still primed to move further, but actually what I probably would have done, let's do what I would have done in this case, okay? What I actually would have done in this case, oh, sorry, folks. Let's go to big charts. And I'll go 2 months. Maybe I should go 3 months. I'll go 2 months. All right. Good enough. Got in here, still at the bottom at about 62. Where are we at? The 19th, at a peak. That's usually when I end up doing it right when it's at its top, its first top. So on the 19th, looks like the stock was above 66. Okay? Now I probably would have rolled here, but we're going to go to the 19th, 15th to the 19th. Okay, why is that important? First things first. Let's add this to the portfolio. We're going to add it to ATVI, Fernando. We're going to do a comparison at the same time. I'm going to show you how I would add to the position, okay? I'm going to show you how I'd add to the position, but first things first. Original position for ATVI, okay? That was my original trade. Now, new view. We got to go to the chain again to do a lot of this, so that's fine. A fair portion, I should say. All right, so I'm on the chain on a second window. I've got to go to December, and we said 19th, 18th, 19th. Let's go to the 18th. And assuming I'm keeping the same expiration at the time, 151 out. Stock's now, okay, 66.01. There's two things I want to look at here. Number one, okay, at this point, I would have rolled to the 67.50 from my 62.5. That's kind of obvious. Okay, so that's one thing I want to take into consideration. Okay, and in fact, let's do it right now. Hold on. Bear with me 1 second. Oh, go away. There we go. Sorry about that. Opened up a whole thing there. Okay. May. 62.50. I think that was right. Let's take a look. If it's not right, I can edit it. Yep, okay. So I've got duplicate positions. Oh, this one I didn't edit properly. Okay, but anyway, we've been in it for 52 days. Okay. Now, this is where it gets tricky. If I wanted to roll this position back on December 18th, deck 18, stock at 66.01, and the 67.5 put was at 630. Okay, so how would I do this? Now there's two ways I could do it. I would likely just roll up the put. I'd sell to close my put for about 385 and buy the 67.5 as we mentioned for 630. Okay, so that's what I would have done on December 18th, if I hadn't done it already. Okay, so I'll use this one. I know, this isn't your request. I'm selling the closed one back on December 18th. And we're going to buy the May 67.50. Same date, 12/18. $6.30. Remember, the stock was at 66.01. All right, that gives me a good measuring point. Okay, so here's this position that I've rolled. Got the 67.5. Now, how did that change our structure? Remember, we started off with a risk of about 5% or so, 5.2%. Now I'm down to a risk of 1.3%, cost basis of 68.36. Your position, and let me edit this to get the dates right, otherwise it's going to look strange. I've got to edit the dates, otherwise it won't read it right if I put in a date of December 18th. So my transaction date was actually December 5th and December 5th. Okay, that's fine. Now, here's where it gets tricky. I want to add another 100 shares of stock at 66. Okay, so the first thing I want to do is average out. 61.96 plus 66.01 divided by 2. My new cost base is $63.98.5. Okay, $63, and we'll call it $63.99. Okay, all right, so let's keep that in mind. Now, I'm going to buy 2. On December 18th, I would have bought 2 puts at 6.30. So that's a cost basis of 12.30. Now, I'm doing this manually because I don't have a way to actually do it. But, see, I can't roll this one leg to 2 legs. Actually, I can. But let's try this. Let's do it that way first. So here's what I do. I'm adding in another 100 shares, but I have to do that manually. So I'm going to edit the position. And I'm just going to edit the stock first. Okay, and I'm going to say on December 18th, I have 200 shares with a cost basis of $63.99. Okay. Now, there is already a note made from when I originally entered the position, so that's there. But now, I'm going to try to roll this. I actually don't know if this works. I think it does because I've done this into an income method number 12 in the portfolio before. I'm going to try to roll the leg. Remember, on December 18th, again, we would have sold to close our 62.5 put for a cost of $385. Rough premium. Now let's see if this works. I'm going to actually buy 2. Well, we know we're going to the 67.50 put, and I'm going to buy 2 on December 18th for a cost of $630. So I'm paying $12.60 and getting $385 back. See if I broke the system. Nope, I've got 202, $63.99 with a cost base of $630, guaranteed to get $67.50 back. Okay. Let me look at the profit and loss chart. Now see, here I have a risk of 4%. By rolling up and adding to the position, we've got $14,000 invested, and I've got a 4% risk. But by just rolling the put, I've got a 1.3% risk. See, when you bought the higher price stock and still rolled to the put, you take on the 5% risk of the new married put plus the lowered risk of your original, so you're at 4% risk. I'm at a 1.3% risk. And now we're both at profit, but where? Okay, so let's look at the married put after I did the roll, the position analysis view. 100 shares, the standard, just rolling the put. I'm at 11% gain, $751, or 11% on my new investment, which includes the cost to roll the puts. And of course, sorry, get out of that. I can roll with income method number, I could do income method number 1, number 3, should be another 4 in here easily that I could bulletproof the position. And you have that too. But if you add it to your position now, go to position analysis. Remember, you've got $14,000 invested. Okay, and you've got to gain about ooh, no, it's close. It's closer than I thought. 8% or 1,106, okay? So you're only about an 8% gain compared to the 11. You saw that you have a 4% risk where I'm at a 1.3, okay? So again, now you can still bulletproof by selling a call, same as me. Some income method number 3s. We should be able to do a lot of income method number 4s here on this position where we could both bulletproof it further. But again, that's how I would add to it, Fernando, to answer your question. Edit the stock first and put in your cost basis, moving from 100 shares to 200. All right, just edit the stock, or from 200 to 300, and so forth. And then after you've submitted that, when you go back into the portfolio, oops, sorry, this would probably appear as, I didn't see it first, but this would probably appear now as a custom spread because you've got 300 long shares that you just edited and 2 puts, but then roll the leg, go to the put, and go to roll leg, and do it that way. And then you'd sell your 2 and then buy 3. And the moneyness will take care of itself because, again, it's taking into account money in and money out. Unfortunately, this is all one position, but you can see here the difference between we sold 1 to buy 2. Okay, and we had 200 here and the 100 here. So that's taking that all into account. Oh, I have to go back one to see 2017, okay? But that's how you do it, Fernando, if you want to add the positions in. Edit the stock first and then go from there, okay? All right. Let's see here, okay. That would be my approach. Actually, that's good that we did that. I didn't know that that would actually, I had a feeling it did. What I've done, let's go back. What I've done in the past is going into earnings. What I've done this before, I just didn't know if it would, it should read it correctly because it's the same thing. Going into earnings, we saw it may be coming out on February 15th, but now that I've got more of a gain in ATVI, what I might do is enter an income method number 12 by selling to close at this price. It's a 72. Might go to, actually I'd go closer. I go to March. In this case, if I had reached the position, I'm at 8% profit, so I would have 75, buying 2 at this price. So I'm only getting, same as yours, I'm only getting $325 back, and I'm going to pay almost $10 for 275 puts. And why would I do that? See, now I have 100 shares and 2 puts. Now it shows up as a custom spread, but that's an approach for income, one of the 4 approaches I might use for income method number 12. Oh, I would absolutely do this if I was in this position. A bulletproof trade where I can't lose any money with earnings coming out on February 15th. I still have protection out to March 2nd. I can't lose any money. If the stock gaps up, I can make more profit. If the stock gaps down, I can make profit. I would absolutely do this no-risk synthetic straddle with income method number 12 on the radioactive profit machine. Instead of rolling up to just the 75 strike for the put to lock in gains, I'd move closer in and do the 2 puts there. And now I'd be in a perfect position where I have a no-risk straddle coming up with earnings in February 15th. Pretty sweet. Pretty nice. Not my position, unfortunately, though, but that's how we would do that. All right, fantastic. Sam had a comment. After January 18, Verizon has a nice move up to 54. You're still holding it from 46, doing a 53 call, rolled to 51. Okay, good. Yeah, Verizon's been strong. I had a couple of people who played that for earnings. Sam said he just did some technicals, Fibonacci extension for future target on ATVI, saw it at 82, and the next quarter, if the earnings are a blowout, it could be at 90 also. I might do ATVI again. I'm not sure. I did that as a married put a few years back, about 2 years back. I don't know if I'm going to do it again or look for a different stock. That's interesting, though. Keep that in mind on ATVI. It might be a fun little play going forward. We'll see what it does. You know, I've got it marked here, and then we've got it in our portfolio. So what's also interesting about this is we can compare the two. I'll put the original married put back in so we can take a look at originally buying at 61.96 with a 62.5 put, rolling up to the 67.50, and then I would have rolled up to maybe the 72.5 or the 75, and evaluate the profits versus adding and the cost basis. Keep a running track record of this. I'll probably have a third iteration in there somewhere on this one. I apologize. I have to adjust my headset there for a second. My apologies. All right, so we'll take a look at that probably continuing next week on. All right, I don't see any other questions that have come in. If I missed a question, I do apologize. I was hoping to potentially get to a question for Michael B., but I didn't get a chance to. I'm going to answer him more in depth later on. Next week, there will probably be 1 or 2 webinars. I want to say probably a Wednesday and a Thursday webinar next week. Thursdays will be regards radioactive trading. Wednesday will be to power options. There'll also be a couple blog articles coming out next week too, Monday and Tuesday, the 29th, of course, and the 30th, related to concepts of radioactive trading, locking in a gain on a long call and how not to do it. That's going to be the first one that comes out on Monday for power options. And I've also got to take a look at analyzing the protecting long calls, as I mentioned, and management techniques on diagonals, some management techniques on diagonals that apply to that as well. All right, so, and I just want to remind everyone, if you haven't yet, make sure you go to PowerOp.com to get a 14-day free trial if you haven't tested out the tools yet. We saw some of them today with the search and so forth. Custom spread tool and more. And remember, the subscriptions after your 14-day free trial that only require name and email address start at $40 per month. A delayed service, most popular, is at $60 per month. And then, of course, we do offer a real-time service, and I talked about that historical access as well, which goes up to an additional cost of $40 above the delayed, but that gives you back testing data back to April of 2006. So you want to check that out if you're interested in back testing as well. As I mentioned, you'll see some invitations to some webinars next week for Wednesday and Thursday, for Power Options Wednesday, Radioactive Trading Thursday. You'll see a couple blog articles come out this week on different comparisons as well, and some other write-ups, both for radioactive trading and for power options. We will be back next Friday, as always. And as remember, send us an email at any time. You can reach us to support@powerop.com, and you can also send me an email to support@radioactivetrading.com, and of course you can feel free to call the office during market hours at 302-992-7971. And remember, trial members and subscribers can schedule a free coaching session. Yeah, talking about that, we were talking about ATVI. I like that one because of the lower price. TTWO has also had a 1.8% move today, can be compared to ATVI. And EA is the other one that's, well, there's a couple others, but EA is also in that group. It was just more expensive, and I chose to go with ATVI when I did my radioactive trade last year, almost exactly about last year, a year and a half ago, I believe, for ATVI. Okay. All right. Well, ladies and gentlemen, that about does it. Have a fantastic weekend. We'll see you soon.